we're going to get into the financial game this week. We're going to talk all about profitability and budgeting for growth. So we're going to go deep into crew budgets. We're going to talk about balanced scorecards. And we're going to talk about how to use a crew budget and a balanced scorecard as a continuous improvement tool. So oftentimes, we get talking about budgets and people kind of get hung up on the numbers and, hey, I haven't had that before. Why do I need that now? We want to really dive into the why behind company budgets, crew budgets, and how using a balanced scorecard actually allows everybody in the company to understand when we're winning and where we're not, and how to drive improvements. Mike, do you want to open up, kind of just give everybody a brief rundown of what the actual company level, department level budgets are in a company?
Yeah, for sure. So, if you've ever been to one of our workshops in our past life, we spend a lot of time on company budgets, and company budgets are the first step in building an important and critical plan for the rest of the company. We need to know that overall, everybody's goals, if you add them all up, are going to come out to be a profitable result. So it's the best place to start. So if you are doing multiple level budgets, as we're going to explain here, you want to start at a company level budget. It's a lot easier to start at the top and then trickle down than to build micro budgets at the bottom, add them all together, and then figure out they don't add up, and then you got to go fix a bunch of things. So the company budget's your step one. And this is overall, as a company, how we're going to achieve our target for profitability, efficiency, whatever that is. And that includes all the big components of the budget that we went through in detail the other day. We're looking at sales revenue, we're looking at labor costs, equipment, materials, subs, overhead, adding that all together and coming out with profit. And in addition, we're going to pull some really key numbers out of that are more than those things. So we can look at things like labor ratio and revenue per hour. And we'll dive into these in a few minutes. But then, and typically in companies that are larger, and when people ask, like, what is larger? Oftentimes you're going to start finding the need to do this when you're exceeding $1 million in sales. Now, that's not to say you can't do it when you're less, or you have to do it when you're more. For instance, if I was $2 million and I only did design build, I might not need multiple department level budgets. I don't have multiple departments. But as you scale the company and you've got these company level budgets, what you will realize is the goals for certain divisions don't work for other divisions. A revenue per hour goal, for example, that would work for a design build department is not going to work for a maintenance department. And maybe neither will a gross profit goal or a net profit goal. So that's where we start getting into department level budgets. And the purpose there is to create those very same profitable plans, but limited to that budget. And then you get to really understand some interesting information too, like how do I recover overhead across these different departments and how much overhead? And then last, but certainly not least, the best way to make all of this meaningful for the people that work for you, and I think that's what a lot of us are aiming to do, is to elevate the people around us, to align people with the goals for the company. The best tool that I watched Mark implement at TBG was our crew level budgets. This is what really, and Mark, you coined this term a long time ago, but like this is what really turned our crews into entrepreneurs that worked within the confines of our business. So every crew thought of their crew like a business within the company. And in order to do that effectively, it started with a crew level budget. And not only did that impart from Mark to the crews a tremendous amount of financial literacy, but it also imparted a sense of ownership of their wages, right? Ultimately, that's what they're looking for. How do I make more money in this company? Well, here's how you can do it. Here's why your wages are where they are today. And here's how we can make them better. And that all comes from having a crew budget that allows us to understand what those profitable goals are so that we can give them to crews.
Yeah, absolutely. I can't stress enough. Having a company level budget for a business owner is like the most enlightening thing I think ever in business. And when you first build your first budget ever, you almost immediately feel like you know the business. It's like you actually can have a relationship with your business and understand it because you can see the relationship between income and expenses. You start to understand why the overhead needs to be managed, but also how to recover that overhead in pricing so that you're not afraid to invest in the business. And those investments, that could be your first shop or your first office manager if you're a startup, or if you're a really large company, it could be starting to hire C-level executives to take on functional areas of the business. Or if you're mid-level, maybe it's bringing on an operations manager so that you can actually work more on the business as opposed to managing and taking care of some of the day-to-day tasks yourself. And so regardless of whether you're a startup, a mid-size or scaling company, or a massive enterprise, really getting in touch with that company level budget gives you all of the understanding of where you can invest in the business and just how much you can invest in the business. And for me, I think most of the time people underinvest in overhead, they underinvest in people. And I think then what happens is the business finds this ceiling as a result of the owner thinking or having a story that they've told themselves that they just can't afford to do more. And that's just simply not true. That's just a story that has been developed based on a lack of understanding of how to put those costs into a budget, how to offset those with revenue, and then how to capitalize on all of those investments. Because ultimately, everything costs money, and we all know this, but when we're investing money, we're doing it so that we can grow the business and grow the revenue. And when we don't budget in advance, we just don't have that confidence in those decisions. And so just like the business owner in that scenario, each crew needs to actually also develop a relationship with the business. And in order for them to do that and really understand how to serve the business well and have the business serve them well, they have to understand how the business actually works, how it makes money, how it's going to either win or lose on a project, how much you can invest in materials, invest in equipment, and how much you can invest in your team, how much you can afford to pay the team. The crew needs to understand that in order to really trust the business to actually provide for them long term as well. And a big component of that is them understanding the financial underpinnings of the business, which, in my opinion, a simple crew budget, it's not a complicated process. A simple crew budget just allows them to plan their year and understand how the business is actually going to make money and afford to pay them. And at the same time, it helps them understand just how much opportunity there is in the business, because as it grows, they grow with it and their wage should grow with it as well. And when they understand the financial component of the business, then they want to do that with you. And so this is why it's such a foundational thing that needs to be in place. Mike, did you want to talk a little bit about the balanced scorecard?
Yeah, not only does the budget set the owner's mind at ease in the sense of planning the business, but then it drives the conversations that are going to happen throughout the rest of the year that we're going to have in meetings and we're going to have with the various departments and certainly right down to the crews about whether we're doing the things that we need to do to achieve the results that we're aiming for. And so once you're done your budget, not only do you have some goals and a plan and some markups that you could use for estimating, but one of the most important outputs is you get the metrics, some of them anyway, that we're going to need to drive the balanced scorecard to have really good conversations that all tie back to the profitable plan in the company. So looking at an example here of a company balanced scorecard, we've got things like gross profit margin and net profit margin. And those are things that come directly from the budget. And as we get more nuanced with this and we build departmental scorecards and even crew scorecards, and we're going to get to a detailed example of that in just a few minutes from now, but we're also going to be able to extract some key metrics from our budget to set these scorecards in place for people so that we know we're giving everybody goals that align with the objectives and the outcomes that we want to achieve for the company. So again, gross, net, revenue per hour, EBITDA is another one that would come from your budget. High margin job profitability could come from your budget. Your crew efficiency score could also align with the results from your budget as you set targets in your budget for unbillable time. So these are all things that can come directly from the budget. And then as we get into the crew balance scorecards, as we'll talk about in a few minutes, that's where some of the other stuff, even though it's not in the budget, becomes real and becomes something that people understand why we're doing this. Training's a good example. Training is one that, yes, we need for risk mitigation and ideally for insurance. But when we're talking about if I'm a crew lead and I want to grow my wage, and in order to do that, I need to achieve these revenue and profitability targets. Now I can start connecting why we're doing training to things that are important, not only to the company, but to myself as well. And so at the company level, your budget is going to be the primary driver for a lot of the metrics that you're going to want to have in the balance scorecard to set the tone for your company and then eventually your department and crew level balance scorecards as well.
Yeah, and most of us always have this. I think when we get started in business, we tend to hyperfixate on financial. And I think for years, teaching budgeting workshops, I think oftentimes people really considered what we were teaching to be just like financial learning. And we really did our best as we taught contractors all over North America how to budget, to really look at the budget as this tool that is creating your operational plan for the year and creating the metrics and the targets for everybody to roll up to. And think of the balanced scorecard as just that. It's, hey, we're building a budget to understand how we're going to spend money and where we're going to invest, how much we're going to pay our staff, how much we're going to build in for new equipment or software or technology or a new shop, whatever we might be thinking. And we're putting all these plans together, and that's a financial plan. But more than anything, what we're really doing is we're planning our operation, and we're actually finding out how much we can invest in the business in order for that operation to become as efficient as possible. So I've always really liked to look at budgeting as an opportunity to plan my operation for the coming year, make sure that financially I can afford to do all the things I want to do. But then that sets me up to know exactly how many people I need. And I've always said that people are the leading indicator of growth. Your ability to create people in your business who can finish your sentences, uh, listen to customers, find out what customers want, and then get that work done efficiently. Your ability to create those people is the most important leading indicator in the business. And so on the balance scorecard, we're really fixated on the people component because our employee retention, our employee happiness, the amount of training that we're doing with our employees, and then of course our safety records. These things are telling us how functional we are as leaders at building people. And so we have to have metrics that we're looking at every month to know, hey, are our staff happy? Are they sticking around? And are we actually improving their skill level so that they can help us scale the business? And you can imagine if you're only focused on financial metrics and you're not focused on building people, your financial metrics will probably look good for a while. But if you're not focused on people and your people start to leave, then your financial metrics are going to get really, really bad. And so I like to really think about this balance scorecard as this tool that you're using to keep the business in balance. That's why it's called a balance scorecard. I want to make sure that I've got a strong financial plan with my budget. And while building it, I've got a really good operational plan. But I also want to make sure that I've got a plan in place to grow people and keep my customers happy. And so I want to be also looking at customer metrics. I want to look at my referral rates. How many referrals am I getting? I want to look at customer satisfaction. I want to look at contract renewal rates or callbacks or how much we're spending on warranty. This balance scorecard is an example. We can add more or keep it a little more simple depending on the scale of the business. We kind of flex these up and down. And if you're on our starter plan, your balance scorecard is going to be a little bit fewer metrics than if maybe you're on our scaling or enterprise plan, where we're going to add a few extra metrics for you and your team to manage because you've got a bigger team to manage them. And As the business gets bigger, you need more insight into each component of the four perspectives on the balanced scorecard because more things are going wrong at scale. And so we want to be a little bit more defined as we look at that balanced scorecard. Mike, why don't you kind of take over and just describe how we're using the balanced scorecard to drive continuous improvement in those monthly meetings?
Sure, absolutely. Before we jump into that, do you mind if we take a couple of questions that came in during the
Yeah, for sure.
So I'll take the first one, which is from Chris. And if you could go back one slide, you can see it. So Chris asked, is the customer callbacks target here a mistake? Its target is 5, actual is 4. We're looking at a score of 120%. Sometimes, Chris, goals are negative. Accidents in the workplace would be one. Customer callbacks is another. We don't want to exceed 5. So what we don't want to do is be helping the crews achieve a goal of 100% by getting 5 customer callbacks. We actually want it to be the opposite. So in this case, it's not a typo. If I have a target of 5 customer callbacks, callback being, say, warranty or deficiency at a job, right? And we only have 4, I'm actually exceeding my goals. And so I'm doing 120% better than I had hoped to do. So it's just one of those inverse goals. Same as if you had an accident rate of, or if I had customer callbacks of 10, I would not want to show that as, hey, we're doing 200% of our goal. It's not a good thing. We actually want that to show a negative. And so it'll do that as well. And then Mark, I'll throw this one to you. So Robbie asked, in the hopes that he's not skipping ahead, when he budgets for something like 20% growth, are we doing this monthly or are we better to just flatline it? For example, 20% growth on maintenance in Jan 25 is versus December 24 is pretty aggressive.
When forecasting growth, I think I understand your question. I lost you a little bit there, but I think what you were asking is when we're creating growth plans, is it a monthly growth plan or an annual growth plan? Was that the question, Mike? Or?
Yeah, so I think what Robbie's saying, and Robbie, if you can make sure I'm on track here with a comment or two, but like if he's budgeting for 20% growth, I think what he's saying is 20% growth over the course of a year, or is it 20% growth necessarily by the year? And I think if I can answer the question the way I thought Robbie would be asking it is, we're looking to build a budget, Robbie, where the revenue reflects what you can grow into for the year, but it's revenue earned. So if you're talking about maintenance and you want to grow your maintenance contracts by 20%, you're right. That's a different we won't achieve all of that revenue this year unless we sell it all in January, and then we will. So it's up to you on what that 20% means. If the 20% means, hey, right now I'm looking to sell 20% more contracts this year, then yeah, you would flatline it. Your budget would include that revenue. If you're saying over the course of the year, we aim to add 20% more than we're doing here, but you're not going to incur all that revenue in the year. You're just going to want to budget for the revenue that you'll incur this year. Next year, you'll be that much better.
Great. Okay. Yeah, Mike, do you want to hop into the monthly meetings?
Yeah, absolutely. So again, we talked before on previous sprints about the importance of crew meetings and how often we had them. The monthly meetings that we're going to have at both the department level and even at the crew lead level are going to be the key to making this balanced scorecard real, far more achievable, but also reinforce to everybody how important it is to hit these things. And so they become the conversation structure of the monthly meeting. So rather than just getting in there and talking about anything, we can look at hard, objective numbers to say, this is what we thought, or this is what we need to happen in order for the company to achieve its goals, and in order for the staff to achieve their goals of growth within the company. And then we can look at the actual column to say, and this is what's happening. And that's why in the previous ones too, we talked about leading and lagging indicators. And you're going to see when I get to, in a couple slides from now, Mark's going to go through a crew budget. We'll go through a balanced scorecard for that crew and see, but you'll see there the importance of lagging and leading indicators. An indicator like revenue is a good topic for a meeting, but in April, obviously, we're going to be nowhere near that goal. But we could look at other things like revenue per hour, which would be a leading indicator, which would tell us that we're on track. So these regular meetings become an opportunity to look at both indicators, but primarily the leading indicators so that we know we're achieving the targets that we're hoping to do. And then what that'll allow us to do is every month create an environment where we can look at our results, share them, talk about them, and then make rapid adjustments. This is where we start asking the questions why. And this is where we start getting good answers, because it's not just, as we talked previously, it's not just the leaders giving the knee-jerk answer of the biggest problem that happened to happen this week. It's a more holistic problem. We're looking at a metric that's lagging. And then that's where we all get an opportunity to chime in and decide why we think it's lagging, and then make some improvement decisions. And not only do we get to get a little bit better each time we do this, we also give now everybody in the company an opportunity to be accountable for some of those. We give them ownership of those. I'm sure anybody in the past who's tried to implement change of process in their company, one of the very first things is like, well, how do you get people to do this? Or my people won't do this. Heard that a million times when we were rolling out mobile apps for the crews as an example. But when you engage them in the problem, the reasons of the problem, when the metrics are objective and not subjective, this isn't like I feel like we're not doing as well as we should. We have a number here. We're not hitting that number. Now we all can say, okay, this is what we should do. Great. Now we need to do this. And I think everybody becomes a better owner of those decisions and about those processes that have to happen in order to improve these numbers. And as well, it provides transparency so that everybody in the company, department, and crew levels can clearly understand that, hey, we're doing what we said we were going to do, or these things are getting better, or we're on track to do better, or we're not. And again, it's not just some leader saying we're not doing good enough. And the reason that conversation I think is so hard in landscaping is because generally it's hard work. And so people are working long hours. They're working hard out in the field. And it's just a kick in the teeth to hear after that, we're not achieving our goals, when I don't have full understanding of what those goals are, where we are today, why those goals are where they are. All I know is that I'm out in the field or I'm in the office and I'm working hard every day, and we're working long hours and we're doing what we think we can do, only to hear a month, maybe not hear at all, maybe not hear to the end of the year, that we're not doing enough. And that's how it gets translated. This changes that conversation, so that we're looking at like statistics, so that we can clearly see that, yeah, it's not just somebody's opinion that I'm not working hard. That's not what we're talking about. We're talking about the results from that working hard. And then we're engaging those people and making that better. Some of the core metrics to monitor. Oh, we can jump into here.
Oh, oh.
No, that's okay. I was just going to talk about quickly some of those core metrics to monitor that would have come from the budget, for example, would be things like revenue, or revenue per hour is a great one. It's a great leading indicator. Gross profit, net profit, capacity, and your labor ratio. Those are all good things to watch. And then you can use tools like recurring meetings to have the conversations, but then things like your QuickBooks or your accounting software, tools like operating systems like LMN, spreadsheets, or even just dashboards to bring those balanced scorecards to life in those meetings so we can have good conversations about them. So we just simply get them updated before the meeting, and we bring them to the meeting and we can talk about that. And then some people can even figure out ways to make these dashboards more relevant all the time, so people can check in with them while they're out in the field at any time of the day to see how we're doing, or at least more regularly than just monthly. We can go to the next one now.
All right, so just before we're going to jump in and do a detailed overview of a crew budget, and just how we're going to talk about just how important having crew budgets is for the business, and how to dovetail the crew budget and the metrics that you come up with from either a company budget or a crew budget into a balanced scorecard for the company or the crew. So the whole point of having balanced scorecards is we want to cascade these balanced scorecards throughout the company. So what we're looking to do is take a company level balanced scorecard, and then we want to break that into a department scorecard if you have departments, if you're a little bit larger company, or a crew scorecard. And so the key metrics that we're looking at diving into on those scorecards are always going to be financial, operational, customer, and people. So those metrics are pretty simple. We're going to go through some today in more detail. Mike just shared a few. So as we kind of look forward and you think about where is this data coming from, I think it's really important that you create your single source of truth for the data points that you're going to put into the balanced scorecard. Now, this is going to come from many different places for some companies, or may just all be coming from one place in others. And so it's important that you identify where these metrics come from. And so today, as we go through this working session and we show you how to set these up and where to get these metrics from, you're going to be considering your list. That's probably going to be QuickBooks or your accounting program. If you're using LMN or another CRM, you're going to probably be getting some metrics from there. You might be using something like HubSpot or Salesforce if you're a larger company and you've got powerful CRM set up. In any case, we're going to use those metrics from those systems of record on an ongoing basis to update the balanced scorecard and make sure that everybody's clear on what's happening. And so I want to kind of make sure that people are really clear on where they're going to get their data from this week, because as we start to move into the faster moving pace that will happen in these weekly sessions where we're deploying improvements, we just want to make sure that you can measure them and that when we create SMART goals, that the balanced scorecard is actually tracking what's happening. And when we're meeting, when you're meeting each week or each month with your teams, that the data is accurate. And so the big key to running this LeanScaper operating system that we're teaching over the sprints is your meeting cadence. And we talked about that as one of the first things as part of this whole series for a reason. Your monthly meetings become your delivery mechanism for continuous improvement. Your one-to-one meetings that you're having either weekly or bi-weekly with staff, your department meetings, your weekly leadership meetings, all of these meetings are continuous improvement delivery mechanisms. When you start to look at meetings as being the tool that you use to improve, I think they hold a much different meaning than general communication. I think every employee in the world will tell you that they would like better communication in the company. And I think just simply holding meetings doesn't really accomplish that. What really has to happen in the meetings is a very standard way of approaching meetings where we talk about our goals and our metrics, and the balanced scorecard becomes that framework. So in every meeting, whether it's a one-to-one, a department meeting, a leadership meeting, or an all hands meeting in the company, we want to start every meeting out talking about the results that we're currently seeing. And that just allows us to talk about reality, which I think creates an unbelievable difference in the way that we communicate and talk and collaborate in our businesses. Because when everybody sees the business through the same lens and truly understand how we're doing, where we're winning and where we're not, then the conversations become a lot more meaningful. Everybody's talking about the thing that needs improvement. And if you think about it, if 50 weeks a year, you're constantly thinking about deploying an improvement and you're talking about your biggest gaps that you're seeing in your balanced scorecard, you're naturally focused on continuous improvement. And the point of the meetings is to get everybody in the company doing this on a regular cadence and talking about the improvements and the problem areas on a regular cadence so that we're just always thinking about improvement. So the balanced scorecard becomes that framework to do so. Now, Mike, maybe you could talk about some of the next steps in actually making this all happen. I think I kind of talked about the meeting cadence, but what are some other things that you've noticed in our own companies or with customers, as they kind of get into doing this? What are the roadblocks, or what do you think people should be really focused on getting done right now to set up for a really successful 2025?
Sorry, it's a good question, and I'll try to answer that while also answering some questions that have appeared in the chat. Uh, I think one of the first and most important things you can set up from your balanced scorecard or budget approach is ensuring that you've got A, the right metrics to watch, but B, that metrics that are going to be achievable for you to extract. So one of the things that I think people trip up on most commonly is they try to get a lot of metrics and they haven't necessarily thought through exactly how we're going to get that metric and how accurate is it. And so when we set it up, a balanced scorecard, for example, without considering how do we pull this data and do we trust the data that we're pulling, what we end up with is a balanced scorecard that tends to fall apart halfway through a quarter as you quickly start to realize we can't update this often enough, or we don't have the right information to offer it up enough. An example for us back in the days of paperwork was like collecting that paperwork all the time and then getting that back out to the crews. And A, half the time we didn't get all the paperwork and we knew it. So now I've got a partial bit of information. And B, because it was paperwork and it wasn't validated, there was all kinds of exceptions. And so the numbers that we were portraying were never quite accurate. We'd have way too many hours booked to one part of the job and no hours to another. And everybody knew it wasn't right. And so the effectiveness and the engagement level at the balanced scorecard level goes down really quick. When you can't present information that is accurate and you're starting to make excuses or stories around the data, you're going to lose engagement. So I think one of the most important things you can do is set up your balanced scorecard in a way that I would way rather be accurate and easy than perfect. And I think you're going to run into a lot of metrics that you're like, well, it would be really great if we had this, and it would. But reality might tell you, well, we can't really get that accurate. So, or getting that accurate is an immense amount of work and not necessarily going to be commensurate with the goals. So I'd focus on creating a balanced scorecard that gives you metrics that you're really confident in, that you can quickly and easily pull these things and steer on the side of right versus perfect. I think it's just way easier to start right. And so that's step one, I think, for me, is extracting from the budget some of those numbers. And now I wanted to answer a question from Scott in the chat there, as he asked a pretty specific question about this, right? And in doing this, these are exactly the questions you should be asking yourself. Scott asked, when we're looking at revenue per hour as a benchmark or balanced scorecard number for the crews, are we looking at just direct time or are we looking at indirect time? And Scott, the answer could be both, because they're both super relevant. When we're talking about revenue per hour, I tend to lean towards just direct time. And why that is because when we're estimating, we're not estimating indirect time. So when we set up a balanced scorecard type of approach to revenue per hour, and we say it needs to be $150 per person per hour, as an example. Well, that's a number that I can set to estimators to say, as we turn estimates out the door, we expect this to be the benchmark revenue per hour for our estimates. So now our estimates are automatically aligning with our company goals for revenue and profit. And then when the crew works off that, they have a balanced scorecard that shows them how much revenue they've earned in a year and how many hours that crew has worked in total and on jobs. And then we can look at that and say, okay, are your job hours in line? And then it just is easier. It's an easier conversation because it relates to estimating. That said, both are good. So if you also said, hey, I want to do both. I want to have my just direct time revenue per hour and my indirect and direct time revenue per hour. That's great, because then you're also aligning the crew around minimizing the time they spend on indirect time, because that's going to impact that number that you're looking at.
I think that's a very complicated way to do it, though, being completely honest. That's a lot of tracking. If your estimating system shows that the total number of hours and the total revenue earned, it's saying that's your revenue per hour. To try to then track the revenue per hour with direct and indirect, maybe I think it's just overkill. It's probably an example of just like going way, way further than you need to. We just always tracked revenue per hour for against the estimated hours. And we factored our downtime into our hourly rates, which covers off the other indirect revenue per hour. And I really think you should always bid with your expected downtime. In other words, if you know that 20% of the day is driving to and from your job sites, put that in your hourly rates as a factor of downtime, and then you're just talking a revenue per hour. Okay, so let's jump in. Mike and I are going to do a little bit of a deep dive on a crew budget because I think what we've learned over the years is that people think crew budgets are really complicated, and they're not. We really believe that you can teach a crew how to budget in the matter of 2 to 3 hours. Mike, in your experience, did you ever find a crew leader that couldn't budget? I mean, you've taught thousands of companies how to crew budget over the years. Probably nobody has taught as many as you have. What have been your general experience with actually showing a crew leader or an entire crew how to budget? Just, as a quick overview before we break in.
Yeah, super quick. I think the first concern most people have is how much transparency. We're going to solve that one really, really quick. We don't need to break down every overhead expense and exactly the contribution that that crew is going to make to that. We can summarize that information. I think what's really impactful is that crew understanding that of every dollar that comes in, what that pie graph looks like. This much goes to labor. This much goes to equipment. Oh, okay, that's surprising. This much is going to get eaten up in materials and what's left. And what has happened, I would estimate 100% of the time is, yeah, absolutely. Within 2 hours, you can build a crew budget that is transformational to that crew's attitude towards work. They have so much of a better understanding of what they do every day and where the money goes. And I haven't yet to meet an owner who says, and I shared too much information. I've just never heard a story ever where that's come back to bite them. And you'll see as Mark goes through the details how you can structure that in a way that's both transparent and confidence inspiring.
Great. So what we're looking at here is a crew budget, and the big importance here, and the thing that we want to really take away from this is where some of the metrics in the balanced scorecard come from. When we make recommendations as standards or industry benchmarks, we make those based on our deep knowledge from building software that help people budget. So those important metrics on the balanced scorecard can usually, for the financial, come from your budget. Now, whether you're using QuickBooks to budget or LMN, or maybe you've got a spreadsheet, in any case, you've got the ability to find these key metrics. Now, the key metrics that we've really managed our business to over the years are the field labor ratio, the equipment ratio, materials ratio, and the overhead ratio. Now, what they clarify for us is gross profit and net profit. And so we're going to go through this budget, and I'm going to explain each ratio and why it's so important that you understand it in your business or on a crew. Now, what we're looking at here is a LeanScaper crew budget, and we've set the sales targets here for the Softscape component at 270,000, hardscape 230, and lighting at 50,000. So this is a crew that's going to go out and they're going to produce these three types of work. These are their major service areas. And they're going to get a target handed to them for $550,000 worth of work in the coming year. And you can see off to the right here, we've got an increase of 64%. So we're adding 64% more revenue to this crew. So something is significantly going to have to change in order for us to get that increase. And I think as we build a budget, in order to make this happen, it's really important that we think about how are we actually going to build a crew that gets this 64% increase in revenue, because that's not an easy thing to do. And we all know that's not an easy thing to do. And this is where a budget becomes this operational tool where you can start to think about what is it going to take for this crew to actually perform this way. Now, when you do a budget with a crew like this, what you're actually doing is you're teaching them to think strategically about what has to be true in order for that crew to deliver these type of results. And so it becomes this strategic working session as opposed to some kind of a finance session. I think oftentimes people think of a budget as being something that the crews shouldn't need to be involved with. But in my opinion, it's a strategic session where they get to help create the plan that they're going to run in order to hit their sales goal. So the first component of that is the field labor budget. Now, when you're teaching this to your field crew leaders, and maybe this is your first time seeing a budget as well, and if you don't have a company budget, by the way, 2 weeks from now, we're going to hold a free budgeting workshop. It's going to be a 3-hour workshop. We're going to go from A to Z on budgeting. Mike's going to present that. He's going to show you exactly how to create a budget. We're going to use LMN to do that because we know it's a very easy way to budget. And everybody here can set up a free trial, whether you're using LMN or not, and build your budget. We'd highly recommend that you set up an account in advance of attending that. But what we're going to do is we're going to go really deep into each area. Now, for today, we can only spend so much time on this, but your field labor budget is your opportunity to create your plan for the coming year. So in this case, because we're planning to increase the number of dollars that this crew is producing by 64%, we're going to increase the staff. And so this would be a scenario where that crew leader is saying, hey, listen, I think I could manage a bigger crew. And now that I've got my apprentice from last year up to speed to the point where they can work independently and operate equipment and lay pavers or go out and maintain properties without me being right over their shoulder, whatever that type of work happens to be, it's time to add another person to the crew. And so with more hours available and more skill available, we should be able to produce more revenue. And that's why or how we're going to hit that new sales goal that's significantly bigger than the last year. Now, the best part about building a budget like this is they get an opportunity to see exactly how they stack up against the industry average. Now, what we want to do here is we want to say, for each role, we want to put in how many staff are in each role. We want to put in the hours that we're expecting them to work. And that's pretty easy to come up with, asking yourself how many weeks the season will be, how many hours you want to work each week, and then obviously just a simple math equation. And then I think if you are paying out overtime, updating how many hours of overtime you're planning to work. And then I always like putting the bonuses in my plan at full rate, thinking if we hit this sales goal, this is going to be the bonus that this crew is going to get. Now, we're going to have some upcoming sessions in February where we actually go deep into incentives and how to use this balanced scorecard to automatically calculate incentives based on all 4 perspectives. So we're going to show you a very advanced but very, very easy to use incentive plan that's actually tied to the balanced scorecard. So the balanced scorecard becomes the incentive plan. Now, in order to plan your year with the crew, they need to know if they've got too much labor or not enough labor. Now, the field labor ratio is that ratio that we're trying to figure out so that we can plug that into the balanced scorecard and make sure that on an ongoing basis, we're not over or under spending on labor. So this becomes the metric that we're really looking for. And if this metric, 25.2, that is what percentage of revenue are we going to spend on field labor? So for every $100 that comes into the company, $25.20 of it is going to go out to pay the field staff. Really important that they understand this, and they understand that if that goes up much higher, there won't be any profit. And so we want everybody to be clear on just how much of our income goes toward the field labor staff. Next up, we're going to dive into the equipment budget. And again, because we're planning to increase revenue, we want to be able to say to that field crew foreman or supervisor or leader in your company, whatever term you're using, we want to be able to say, what equipment would you like to have or would you need in order to hit this plan, knowing that we really can't spend more than 13% of revenue. We want to keep under that, what equipment would you want? Now, again, maybe last year they only had a pickup truck, and this year they want a 5-ton dump truck. Let's go ahead and put the cost of that in their budget. We've got an excavator, we've got a skid steer, and then we've got an installation trailer that's fully loaded with all the small tools and equipment. Now, when we've got this number and we know now exactly what it's going to cost for the year, our total expenses are 64,000 in this case. All we have to add in is the fuel, the repairs, and the insurance costs for that crew. Now, they're again starting to understand just how expensive the equipment is. They're starting to see that we have a repair budget for their equipment and that we can't exceed it, which helps them become more aware of the importance of maintaining and being careful with the equipment. But more than anything, what we're really trying to do here is give them an opportunity to say, I'd like to have some bigger equipment, or I'd like to have more equipment. And if you give me more equipment, I can produce more work. And so again, you end up with this partnership type discussion. I can think of a time in my own company where we were going through budgets and we decided, actually, some of the guys came up with this idea, is that why don't we get these bigger dump trucks that have 16-foot dump boxes on a 20-ton truck that will allow us to haul a big float, haul our tools, take 14 to 15-ton loads with us. Why don't we go ahead and buy these trucks? And it was a very easy conversation because we put the cost into their budgets. And when we built the cost of those far more expensive trucks into the budget, we still were within the labor ratio. And they felt that those trucks would eliminate a lot of downtime, eliminate a lot of waste, allow them to carry more materials, get more work done each day, produce more revenue per hour. So we went ahead with the plan and we ordered the trucks because of that. But again, the ideas come in when you actually go through the budgeting process because it is a strategic planning process. This isn't something that we're just simply doing for financial outcomes. We're doing it to plan the most efficient year. Next up, materials. Generally your field crews don't know exactly what these ratios are. So you're helping them here. You're explaining to them what the material expense is likely to be. And you can grab this information by checking past materials against revenue, or we've definitely got a lot of insight here at LeanScaper. Generally speaking, what we're seeing is 20% to 25% on materials for companies that do a lot of mixed installation work, hardscape and softscape installs. And for maintenance companies, it's usually quite a bit lower. We're usually looking at 10 to 15% of revenue, depending on how much materials you allocate to maintenance versus enhancements. But again, when we build this, we want the crew to understand what percentage of the revenue is going into material for the type of work they do. And then we're not concerned with subs for the crew budgets because unless they're truly managing that sub on an ongoing basis, it's really nothing to do with their crew. And so we kind of jump to overhead. And Mike mentioned this earlier. For overhead, we're just giving them an allocation. We're not asking them to run through our entire financial background to tell us to decipher how much of the overhead is theirs. This is a company allocation. And so this is us saying that at the company, our overhead is 20%. So we're going to add a 20% overhead line to your crew so that you can contribute to all of the overhead in the business. So it's just an allocation, very simple. Some companies, I'll say, if they're operating at a really high profit, we'll sometimes add a little bit to the company allocation for overhead recovery to hide some profit from the crews. Now, for me personally, I don't think it's worth doing that. I think it's just easier to be honest. There's one profit target. And in this case, this budget is going to be 17.2. If I didn't want to show my team that we make 17%, I could add to the allocation here and bury some of the profit in my overhead. Now, I've seen people do it and lots of people do, but I'll be honest, I just think it's easier to talk about profit transparently. And I think it's really healthy to talk about profit and talk about a 15% plus profit margin openly and confidently, because I think every employee in the world goes to work for themselves, and they go to work for themselves and they choose a company they go to work with. And I think they choose companies that are profitable and successful, knowing that a company that's highly profitable has more money to invest in growth, a lot more money to share when it comes time for bonuses and future raise increases. And I think generally speaking, people want to work for successful people. And so if you're hiding your profit and they think the company is not healthy, then I don't really think it's an aspirational company to work for. So, generally speaking, I always say profit is not a dirty word. We want to be able to say what it's for. Profit is growth capital for the future. It's bonus for everybody involved. Sure, there's some return on investment for the owner, but ultimately, most of the profit is being used to cash flow the current operations in the business. As we produce profit, we're using it to cash flow the business and to fuel the future growth. So I just think it's a healthy thing to talk about. And I think when you have budgets, people really start to understand just how slim the margins are in this business. You can see this crew is going to produce a $94,000 profit. And that sounds like a lot, but I think we all know when you start to buy equipment and cash flow these people each week on wage and cash flow the projects, and you start to invest in the business and invest in people, this 94,000 drops very quickly. And I think it's just smart to be honest about it. Now, when we get to the profit and loss here, what we're really driving at for the balanced scorecard are these ratios. We want to know throughout the year if we're on track on ratio, because it's very hard in month 2 or 3 or 4 when you're just looking at what you've spent in labor to be confident on whether or not you're on track. But I'll tell you, like, I've always just looked at ratios. I would look and say, on any day of the year, I could pull out of QuickBooks or LMN, what ratio am I actually spending on field labor wages? And that is the leading indicator of everything. So just like estimated versus actual hours is on a project, the field labor wage ratio tells me if overall or if we're working efficiently or not. If that number was 25.2 on this crew budget, but the balanced scorecard was telling me that they're actually at 30, I would know that we either have an estimating problem or a productivity problem or a combination of the two. And so what we're going to teach over the throughout the year on this continuous improvement program is how to use the balanced scorecard to predict your problems and to get in front of them and create improvements that actually eliminate these problems systematically. And so again, with the field equipment, we want to know this ratio. It's 11.7%. I want to make sure it's that or better every day of the year. And if it's not, I want to know why it's not. And that's really the point. Material costs, again, we want to get the ratio so we can monitor it on the balanced scorecard. Our total job costs, these are our direct costs to produce the work, the job expenses. We want to make sure that they're at 62% in this case. And when our total job costs are 62%, the only expense that's left to pay is the overhead. So once we've paid our overhead, which in this case is 20%, we're left with our profit. So our gross profit allows us to pay that 20% overhead and still make 17.2% net income. So all of these metrics slide over into the balanced scorecard, and then every week or every month, depending on which meeting you're in, you're always reflecting on these ratios to decide whether or not the company's healthy. And then there's a few other key metrics that we get from the analysis tab down below, which again, these metrics are really important percentages or amounts to have in mind on the balanced scorecard. So the most powerful that everybody here has probably heard us talk about, because we talk so much about revenue per hour, this number is really important to get by crew, by division, and company wide. And the reason that we want to be so confident here is we actually want to create rules of engagement around revenue per hour. We want to be able to say to our estimators, never bid a job for this crew that doesn't produce $122 or more per hour. And that's a really important component. This one rule will save your company and help you scale your company beyond anything. If I never put out an estimate for less than $122 an hour for this crew, then I'm handing them work that allows them the opportunity to win. And in most companies, what happens when the crew's not hitting revenue goals, what happens is usually the field leader, crew leader blames the estimator, and the estimator blames the crew. Well, what these metrics do is they connect everybody. The estimator can't produce bids for less than 122. The salesperson, if it's a separate person from the estimator, can't ever go sell a job for less than 122. And that field crew leader knows that every job they get handed to them has at least $122 an hour of opportunity. So if they get the job done on time, then they're definitely going to win this year. So that revenue per hour target on the balanced scorecard is a byproduct of the budget. That's where this number comes from. And then your efficiency rating, which comes on, again, a balanced scorecard item, your efficiency rating is also a byproduct of your budget. We want to know what our planned efficiency for the year is, so that every day of the year we can look at that crew score if you're using LMN, or look at your balanced scorecard and understand if you're actually on track. And so this efficiency rating in this case is 83%. So we're saying we've already built drive time into our pricing. We've already factored some expected unbillable time at the shop and yard, and we've already put training hours in our overhead budget. So what we're saying here is every day we're only expecting the crew to work at 83% efficiency, factoring in all of that other unbilled time. And if we actually were able to somehow exceed this, then this crew could actually produce a lot more revenue than planned. And that's where the motivation starts to come from, is we start to show that, hey, this crew is actually capable of producing $650,000 worth of revenue, and we're only budgeting for $550,000. So this crew actually has another $100,000 worth of opportunity that we're not really capitalizing on right now. And when you do crew budgets, they begin to see this. And then what we like to do is say, hey, your incentive plan works very simply. You're going to get your incentives if you actually exceed the plan. And that's really what we're going to walk into over the coming weeks with the balanced scorecard, is showing you how to use this to actually promote your staff to exceed the plan. And the balanced scorecard becomes a very, very motivational tool when we do that. Mike, I realize we're running up on time here. I got away from myself there. Do you want to just kind of tie the metrics we just talked about into this balanced scorecard that I've got up on the screen here as we wrap up?
Yeah, sure. So, and I'm not, if you could zoom in with the buttons on the bottom just a little bit, Mark, it might be easier for people to read, but yeah. So as Mark said, we've got a crew budget and there's tons of good questions happening in the webinar. And as Mark said, we're starting to run on time. So I'll promise you this, if you're on this webinar, I'm going to go through those questions and make sure they're all answered in the community if I don't get a chance. But some are asking, do I do it for all crews or do I build one for each crew and whatever? And those are excellent questions. We'll go through all this. But essentially what we're doing is taking those crew budget metrics, and they could be by specific crew. They often are, but they also could be rolled up for a couple types of crews. There's some rules around that I want to have time to explain, but certainly doable. But now we can take things like the revenue or the revenue per hour from that crew budget, bake it into the balanced scorecard. And the crew now understands not only why the number is what it is, but as we go through each month and have these meetings, whether they're trending to hit that number or not. And then when they're not, getting that opportunity to participate in the improvements. And I think that part is gold. Because as Mark mentioned earlier, like sometimes it's an estimating problem, sometimes it's a logistics problem, an operations issue, scheduling issues. There's all kinds of reasons why we're not hitting our revenue targets other than our crews just aren't producing enough. That's a reason too, but it might not always be that reason. And this is that great chance to have those conversations that are going to surface those numbers for the crews so that everybody gets a chance to really understand why we are or are not hitting those goals. And then the one other thing I'll bring up is it allows us to have really good conversations. I talked about it earlier about those things that aren't coming directly from the budget, but absolutely influence the budget. So customer satisfaction. If we don't have a continuous process to making sure our customers are satisfied, we're not going to hit revenue targets because we're going to have trouble selling work. If we can get customer reviews, we're more likely to sell more work to those customers and to everybody they know. The training we talked about earlier, if I can build up more efficient crews, we're more likely to be able to produce more revenue because we're going to have more efficient days, less callbacks, less issues, all that good stuff. So not only does it connect the crews with the results from the budget that Mark just went through, but it starts to tie together why we're worried about all those other things. And again, really, really importantly, bring that improvement up in balance. We're not focused, it's great, estimated versus actual hours, perfect benchmark for crews, but it's not the only thing. And people have asked a million questions about, well, what about this and what about this? And all the answers are, yeah, those are all important. That's why the balanced scorecard is so important. It brings so much more holistic information other than just on this job, we need it done in so many hours.
And what you measure is what you improve generally. And the big point here that we wanted to make today is when we build a balanced scorecard and we create simple metrics that we can put in front of each crew or each division, what we're trying to do is we're trying to tell them that these are the important things to the business. Our financial outcome is important. That's our fuel. Our operational efficiency is super important because when we eliminate waste, we can pay our staff more and make a better profit, and our customers usually get a better end product. When we invest in people, we actually get more efficient and we get happier customers and we get better financial results. And so we need to be aware of that. And any business owner that ignores their happiness levels with their people or ignores the training needs of their people always ends up hitting a glass ceiling pretty quickly. And last, and certainly not least, we just want to make sure that all of our crew leaders are out there feeling the obligation or the need to get better customer satisfaction levels, to ask for reviews, to make sure that we don't have warranty callbacks. And so what we measure, we improve. And the balanced scorecard is just that. It's a continuous improvement tool that allows everybody to know what's important. And that gives us the opportunity to have a meeting where we can talk about things rationally, leave all the emotional garbage out, and just talk about the rational metrics, and then decide what is it that we're going to do to drive improvement in any one of these areas that needs it. And that way we're not always just hyper focused on getting better at the things we're already good at, which I think all of us are guilty of one time or another. But again, thanks for joining. We are out of time. Any question you have, please put it in the chat right now. We're going to answer all of those in the community. You can count on, after every one of these weekly sessions, a whole series of answers, Q&A answers being posted in the community. We've created our own internal system where we write some articles specific to answer some of the bigger questions or the more common questions that we're seeing. Mike put a great one out this morning just in response to one that we had earlier this week. But the questions that you ask really help us know exactly where to help and fill in some of the blanks. So please throw your questions in the chat and get into that community and get conversational. The community is there for us all to collaborate and share best practices. So we'll be posting as often in there as possible following any of these sessions. And of course, all of the attendees will have access to the recording of this session as well. So thanks again, everybody, and we'll see you next time.